Its dividends every month around 7%. So is it really a buy now? Is it undervalued? It's Main Street Capital. Let's take a look at the company. Obviously, we'll run through that dividend safety as well, which is important for a high yielding company. And we can find out whether or not it does hit undervalued on our model, looking at that intrinsic value and acceptable buy price. So let's jump straight in. It is up 15% year to date. It is trading towards the mid to upper end of the 52-week range with a yield of 6.81%. Now, if you have been holding this BDC over the last 10 years, you would be up around 47%, but do remember it doesn't include those dividends reinvested. Now, what we typically like to see around 5 to 10% growth year on year. December 2018, 233 million. Now, when we look at the more recent annual report at 378, we do see some nice growth over the last 5 years. On a more granular level, we do see it increase to 2019 before dropping and then picking up all the way to 22. And we also see the trailing 12 months showing signs of a very, very nice growth to the top line over the last year. So overall, over in fact the last 6 years, it looks like the top line is expected to have doubled. So that is a very positive sign. When we compare that to the bottom line net income, again, we do see inconsistencies every year with growths, drops, and then picking up again. But over the last 5 years, not only has it increased, but again, similar to the top line, that bottom line trading 12 months is showing signs that that net income will have more than doubled over the last 6 years. So very positive in terms of their growth over the last 5 to 6 years. It is moving in the right direction. Yes, there are inconsistencies, but overall it does look positive. Now, a quick health check for the company, their total cash versus total debt, 54 million in December 2018. Latest quarterly report showing 77 million. So their cash position has increased over the last 5 years by around 50%. But what does their total debt tell us? So what we can see, 1 billion in 2018, just under 2 billion from their latest report. So yes, their cash has increased by 50%, but numerically and percentage, we can see their total debt has increased by a much greater rate. And we'll look at that dividend safety shortly to see how bad or how strong that dividend safety is. Now, we have some other companies in the same sector. We have Gladstone Investment, Midcap Financial, Ares Capital, as well as a few well-known others. Now, year to date, with those dividends reinvested, remember these are monthly dividends at just under 7% currently. 22.45%. It is one of the best performing in the industry, although we do see the majority of them having positive returns. We also have Gladstone Investment, which we have analysed on the channel recently, also very strong. Now, over the last 5 years, while Main Street Capital is up 58%, one of the worst performing, but interestingly, it is still up a very decent percentage over a 5-year period. And do remember, they do pay monthly, so that is an added bonus for investors who do like that income on a more fixed and regular schedule. Now, what are the institutions doing? Well, around 20% institutional ownership. 49 billion or million in fact worth of buys by these institutes, but sells in fact by these institutions over the last 12 months, and 3 times as much buying by these institutions over the same period. And we can see over every single quarter over the last 4 quarters more buying than selling by these institutions. So it is one that they have been adding and that they do continue to add and enjoy. But as always, we need to do our own due diligence and not just copy what the investors and institutions do. Now, in terms of how their earnings have been over the last 4 quarters, well, they did miss, unfortunately, in both their earnings per share and top line over their more recent quarter. But if we go back the last 3 quarters, Q2 of 23, they beat on both the EPS and top line. Again, Q1, they did beat. And if we go back to Q4 of 2022, they did beat both as well. So very positive to see, especially when we analyse a Q3 23 versus Q3 22. They beat on pretty much every single metric. So they are increasing all of their top line numbers and bottom line from last year when looking at Q3. So very positive to see so far in terms of the growth. Now, dividend safety, it is nice to see it is safe, especially when you are looking at a yield of nearly 7%. That is a score of 62, 3.5 billion, so it is a mid-cap company. Now, in terms of some recessionary metrics, they did maintain their dividend during the 07-09 recession. Now, negative 7% sales, but remember that was above the average growth of companies in the S&P, which was just purely negative to a larger degree. And they also outperformed the S&P 500, negative 25% to the S&P's negative 55%. They did have what I would call a very mediocre / poor increase in November this year, so just last month, of 2.1%. The reason why I say that, yes, the dividend yield is high, but they're not keeping up with inflation. I would have liked to see at least a minimum of 4%, which we see on average over the last 10 years, with the last 5 years being 3%. They have been paying increasing dividends over the last 12 years. And if we look at dividend yield theory, what we can see is it comes slightly undervalued as the current yield sits above the 5-year average, 6.94 versus 6.49. And we see the forward yield of 10.6 versus the 5-year average of 15. Another sign of undervaluation. But remember, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Another thing to note is that they do pay special dividends, which do come once or twice a year, which is always positive to see, on top of that yield that we do come to love with this company. In terms of the sector PE, it is roughly in line with the financials at 10.8, and we can see it is to the mid to upper end of that 52-week range. But as I always say, 52-week high even isn't a signal for overvaluation. Now, for BDC, we'll focus on the earnings. Typically, I prefer free cash flow, as earnings are susceptible to manipulation by management through accounting. But in this case, we will focus on this due to the volatility with BDCs in terms of that free cash flow payout. So below 95% is the preference for this industry and for these companies. Now, what we do see, other than 2020, it has been fairly stable around that 95% level. Positive to see that 22 is at 79%, although 2023 is expected to go even lower, which is even better, and 2024 again expected to be roughly the same. So far the dividend looks very safe, and when we analyse the EPS, we do see, whilst it is fairly inconsistent, it is moving in the right direction. $2 in 2013, $3.30 in 2022, and 2023 expected to be even higher. So it is increasing year on year over the long term, which is always a positive. Sales growth, now what we can see, double digits nearly every single year. Trailing 12 months showing 40%, as we did know when we did analyse the income statement. So it is looking very positive. We have that COVID year of down negative 9%, but it is only the first and only negative year in this period. And numerically, 116 million of sales in 2013, 377 in 22, 485 in 2023. So it does look like it is increasing at a very good rate for an investor who does like BDCs. In terms of shares outstanding, it is essentially typical that they do dilute your position as a shareholder, and that is pretty much what we can see. 36.6 million worth of shares in 2013, 74.5 in 2022, and expected to go even higher. So something just to bear in mind, that it is quite important to understand in the companies that you invest in and what they do, especially on those shares outstanding. ROIC, typically I like to see 10%, but we can move it to that below to 8% for BDCs. On average, it has been around that 7 to 8%, and 2023 at 10% gives me faith in management and their ability to consistently and effectively allocate their capital. Now, essentially for BDCs, we typically analyse the operating margin, free cash flow margin, as well as the net debt to EBITDA. But as we can see, it isn't a meaningful metric for BDCs, purely based on the fact that interest is a core component of their revenues and expenses. So this isn't one that we will analyse today. So let's jump straight into the valuation model. As always, if you enjoy the content values being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. Now, the first model that we normally use would be Graham's valuation. However, for BDCs and for REITs, it isn't one that we do use, so therefore it isn't included in today's Output Essential episode. So we start off with the first one. We have the multiples valuation model. We have Gladstone Investment, Midcap, Ares, the ones we essentially analyze on a 5-year basis. We get their average P multiplied by the essential earnings of Main Street, and we get a stock price of $54.95. Now, when we take a look at that, we can see that is well above the current trading price. In fact, over 30% upside and above the 52-week high. So it does show signs of undervaluation on that model. But do remember, we don't really look at any of these models in isolation, and we will draw conclusions towards the end. We then have the dividend discount model, where we have the yearly dividends. Nice growth rate up to the most current year, where we see that 2%, which is really mediocre, as we stated already. Forward looking, I've gone for 2.5%. It is higher than the more recent essential increase, but it is much lower than the average growth rate of 5.23%. As always, if you do grab a copy of the model, you can play around with these numbers and go for a higher or lower rate depending on your own personal investor preference. This gives a DDM price of $52, and as we can see, that is above the current trading price and again above the 52-week high, again showing signs of undervaluation for this monthly dividend payer. As I mentioned, for BDCs, free cash flow isn't really appropriate, so this isn't a model we will use. So for today's episode, the intrinsic value is just the average of those two models we've run through, and it comes to $54. Now, current price is around $41.40, and we start off with a 10% margin of safety. For those that are new, we use 10% if we believe the company has a wide moat, strong financial metrics, good forward-looking data, and that would be up to $48. At 15%, it's still a buy up to $45, and at 25 or 20%, in fact, it is pretty much a buy around the current trading price. So right now, on our estimates and judgments, you are locking in a 20% margin of safety. Now, what do Wall Street believe? Well, they believe the share price over the next 12 months to go up to around $44, so they believe there to be around 5 to 10% upside. In conclusion, we believe there to be around a 20% margin of safety, with Wall Street saying around a 5 to 10% upside from this point. And do remember, you are getting nearly 7% in terms of dividends every single month. As always, though, let me know your thoughts in the comments below. Is Main your favorite BDC? Is it one you're looking to add? Or maybe you bought at a much lower price and are just holding and waiting for a certain price? Or if you're not interested, let me know what your bearish analysis is on this. As always, if you enjoy the content, do smash that like button, do hit the subscribe and bell so you are continually notified of these videos. And don't forget to click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or watch list. As always, have a great day and catch you on the next episode. Take care.